Hello and welcome to our video on tax planning. In this video, we will be discussing tips for saving on your taxes and maximizing your tax return. First, it's important to make sure you are taking advantage of all eligible tax deductions and credits. These deductions and credits can reduce the amount of income that is subject to tax, which can ultimately save you money. Some common deductions include charitable donations, mortgage interest, and business expenses. It's a good idea to review the list of available deductions and credits each year to see if there are any new ones that apply to you. When it comes to deductions, there are two main types to be aware of: standard deductions and itemized deductions. Standard deductions are a fixed amount that you can claim on your tax return if you do not itemize your deductions. The amount of the standard deduction depends on your filing status and is adjusted each year for inflation. Itemized deductions are deductions that you claim separately for specific expenses, such as charitable donations, mortgage interest, and business expenses. You can choose to claim either the standard deduction or itemized deductions, whichever is higher. In addition to deductions, there are also credits available that can reduce the amount of tax you owe on a dollar-for-dollar basis. Credits are generally more valuable than deductions because they directly reduce the amount of tax you owe, rather than just reducing the amount of income that is subject to tax. Some common credits include the Child and Dependent Care Credit, the Earned Income Credit, and the American Opportunity Tax Credit for education expenses. It's a good idea to review the list of available deductions and credits each year to see if there are any new ones that apply to you. You can find this information in the instructions for your tax return or on the IRS website. By taking advantage of all eligible deductions and credits, you can reduce your tax liability and save money on your taxes. Another tip is to consider adjusting your tax withholdings throughout the year. By adjusting your withholdings, you can ensure that you are not overpaying or underpaying your taxes, which can result in either a larger tax bill or a larger tax refund. If you receive a tax refund each year, it may be a good idea to adjust your withholdings so that you are receiving a smaller refund and more money in your paycheck throughout the year. This can help you to manage your cash flow and reduce the temptation to overspend or incur debt. When you start a new job or have a change in your tax situation, you will need to fill out a Form W-4, which is used to determine how much tax to withhold from your paychecks. On this form, you can claim allowances for yourself, your spouse, and any dependents. The more allowances you claim, the less tax will be withheld from your paychecks. You can also claim additional amounts to be withheld if you want to have more tax withheld. It's a good idea to review your Form W-4 and adjust your withholdings if necessary to ensure that you are not overpaying or underpaying your taxes. If you are receiving a large tax refund each year, it may be a good idea to reduce the number of allowances you claim or increase the additional amount to be withheld. This will result in less tax being withheld from your paychecks and more money in your pocket throughout the year. On the other hand, if you are consistently owing a large tax bill or underpaying your taxes, you may want to increase the number of allowances you claim or decrease the additional amount to be withheld. Adjusting your tax withholdings can help you to better manage your cash flow and avoid overspending or incurring debt. It can also help you to avoid any potential penalties for underpaying your taxes. It's a good idea to review your Form W-4 at least once a year or anytime you have a change in your tax situation. Another way to save on your taxes is to contribute to a retirement account, such as a 401k or IRA. These contributions are tax deductible and can also help you save for the future. If your employer offers a matching contribution, be sure to take advantage of this opportunity to increase your retirement savings. There are several types of retirement accounts available, each with its own set of rules and tax benefits. Some common types of retirement accounts include 401k plans, traditional IRAs, and Roth IRAs. 401k plans are employer-sponsored retirement plans that allow you to contribute a portion of your salary on a tax-deferred basis. This means that your contributions are not subject to income tax until you withdraw them in retirement. Your employer may also offer a matching contribution, which is an additional benefit that can help you to increase your retirement savings. Traditional IRAs and Roth IRAs are individual retirement accounts that you can open on your own. Contributions to traditional IRAs may be tax deductible, depending on your income and whether you or your spouse are covered by a retirement plan at work. Contributions to Roth IRAs are not tax deductible, but qualified withdrawals in retirement are tax-free. By contributing to a retirement account, you can reduce your taxable income and save on your taxes. It's also a good way to save for the future and ensure that you have a stable source of income during retirement. Be sure to review the rules and tax benefits of different retirement accounts to determine which one is right for you. If your employer offers a matching contribution, be sure to take advantage of this opportunity to increase your retirement savings. It's also a good idea to stay organized and keep good records throughout the year. This will make it easier for you to claim deductions and credits when you file your taxes. Keep track of receipts, invoices, and other documentation related to your deductions and credits. This will make it easier for you to prove your eligibility if you are audited. It's important to keep track of receipts, invoices, and other documentation related to your deductions and credits. This will help you to accurately claim these items on your tax return and provide evidence of your eligibility if you are audited. There are several ways to keep track of your records, such as using a spreadsheet or a digital file system. It's a good idea to establish a system for organizing and storing your records so that you can easily access them when you need them. Some common items to keep track of include receipts for charitable donations, mortgage interest statements, medical and dental bills, business expenses, such as office supplies and travel expenses, education expenses, such as tuition and fees. By keeping good records throughout the year, you can save time and stress when it comes time to file your taxes. It's a good idea to review the list of available deductions and credits each year to make sure you are not missing out on any opportunities to save on your taxes. Finally, consider working with a tax professional or using tax software to help you with your tax planning and filing. They can help you to identify potential tax savings opportunities and ensure that you are complying with all relevant tax laws. A tax professional can also provide guidance on complex tax issues, such as self-employment taxes or business expenses. By following these tips, you can save on your taxes and maximize your tax return. Thanks for watching.